Hello there. This video will demonstrate the solution to in-class problem 3.2 on multi-product CVP. So let's look at the information we have real quickly. The company manufactures a line of garden tools. They've received a sales forecast for the year and basically have three products: weeders, hedge clippers, and leaf blowers. They've experienced all kinds of variation in sales volume and variable costs. They provided the following budgetary information. So here we have three products. We have W, we have H for hedge clippers, and L for leaf blowers. The sales, the selling prices, the variable manufacturing cost per unit, and the variable selling cost per unit. Now, from this information, the selling prices, we can actually determine the product mix. So if you look at these, right now there's 50, 50, and 100. Well, that comes down to a ratio of 5 to 5 to 10 if we knock off 4 zeros off each one. Now, because they're all divisible by 5, we can actually break it down even further to make it simple that we, in essence, have a ratio of 1 to 1 to 2. We're also told that the fixed factory overhead is $2 million and fixed selling and administrative expenses are $2.6 million. So this is the F manufacturing overhead and the F selling and admin, which means that total fixed costs are equal to $2,600,000. We've got four requirements, but we'll start with the first one slowly. So our first requirement is to determine the budgeted net income for the year 2020. Just because we're asked to calculate the budgeted income doesn't mean we have to prepare the whole income statement. So we can actually, save a little bit of work and some steps. If we look at requirement 1, the first thing we want to do is calculate the contribution margin. We can jump to net income by determining contribution margin less fixed costs. We've got the weeders that have a selling price of $28 and a variable manufacturing cost of $13 and a variable selling cost of $5. So we would take 28 unit selling price minus 13 unit variable cost minus the $5 unit variable selling cost. And that gives us a $10 unit contribution margin. If we look at hedge clippers, we have a selling price of $36, variable manufacturing costs of $12, and selling costs of $4. So we would take $36 minus $12 minus $4 to give us a unit contribution margin of $20. And then finally for the leaf blowers, we have a selling price of $48, variable manufacturing per unit of $25, and variable selling costs of $6. So we take 48 minus 25 minus 6 to give us a contribution margin of $17. And then if we multiply those each by their expected volumes, so 50,000 times number of units will give us 500,000 in revenue in contribution margin. So this is going to be dollar contribution margin in total. We would take the hedge clippers and multiply by 50,000 units. That's also going to give us this time $1 million. And then if we take the leaf blowers at a volume of $100,000 at a contribution margin of 17, that's $1,700,000. So that allows us then to give us our total contribution margin of all the products combined of $3,200,000. Then we subtract our total fixed costs, which we calculated above to be $2,600,000, and that will give us operating income of $600,000. Now, to determine the taxes, we would either have to deduct the income tax at whatever the rate is, or we could multiply by the after-tax rate. So if we look at the data right here, we have income taxes, an effective tax rate of 40%. If we want to jump right to net income, we would simply multiply by 1 minus the tax rate of 0.6. 1 minus the tax rate. So 1 minus 0.4 is 0.6. 600,000 in before tax income multiplied by 60% will give us net income of $360,000. So there you have it. 600,000 before tax times an after-tax rate of 60% gives you net income of $360,000, and that's the answer to requirement 1. Our next requirement 2 is going to be, assuming that we have the sales mixes budgeted, how many units of each do they have to sell in order to break even? Basically, what we want to do is determine what the sales mix is, which we already know for weeders, hedge clippers, and leaf blowers is 1 to 1 to 2. And then we would multiply by the unit contribution margin of each. Well, we've already calculated the unit contribution margins of each right up here. Weeders have a $10 contribution margin, hedge clippers a $20 contribution margin, and leaf blowers a $17 contribution margin. Well, that's going to give us, part of our calculation for the bundle, $10, $20, and $34 for a total of $64 in bundle CM. Well, the break-even point, which I like to call Q star, is equal to fixed costs over, in this case, not the unit contribution margin, the bundle contribution margin. We know that fixed costs are $2,600,000 and our bundle contribution margin is $64. So that gives us the number of bundles to break even to be 40,625 bundles. But remember, that's the total number of bundles, and so we need to break that out into each of the constituent products. So times 1 weeder is 40,625 weeders, times 1 hedge clipper is the same, 40,625 hedge, and times 2 leaf blowers for a total of 81,250 leaf blowers. That is the number of units of each that are required to break even, and that answers requirement 2. So now on to requirement 3. Here we want to look at how much does the company have to sell, total dollar sales, to earn a target net after-tax income of $450,000. So this is the TNI equals $450,000. Now we can convert that right away to a TOI if we divide by 1 minus the tax rate. Here, $450,000 of target net income divided by 0.6, which is 1 minus 0.4, will give us a target operating income of $750,000, which now we can use to solve our next requirement. So we know now that our target net income of $450,000 translates to a target operating income of $750,000. So we know the numerator, but we need to know, because what I want to do is illustrate this using the contribution margin ratio formula instead of the break-even formula. So what we want here, in essence, is to determine our desired revenue, so we'll call this Q dollars, is going to be total fixed costs plus our target operating income divided by the contribution margin percentage. So I know that $2,600,000 are my total fixed costs, and I'm going to add to that my $750,000 target operating income, again, which is based on a $450,000 target net income divided by 1 minus 0.4. And I'm going to have to divide that by a contribution margin ratio that I don't quite know just yet. So in order to figure out the contribution margin ratio is to determine the bundle selling price and then subtract the bundle contribution margin. So the bundle selling price, as it is right now with the current sales mix, is, remember, 1 to 1 to 2 for W, H, and L. And we know that their individual prices are $28 for the weeders, $36 for the hedge clippers, and $48 for the leaf blowers, and we're going to multiply by their relative mix. So in a bundle, I'll have $28 of weeders, $36 of revenue for hedge clippers, plus $96 in revenue for leaf blowers, for a total $160. This is the bundle selling price. And then if we subtract the bundle unit contribution margin, which we already have calculated previously to be 64, or I can write it again, $10 plus 20 plus 34, that's $64 in bundle contribution margin. The contribution margin ratio, right? Remember the CM ratio is equal to the contribution margin divided by the selling price. Here we can do it on the bundle. So the bundle contribution margin divided by the bundle selling price. We'll take 64 over 160. This is a 40% contribution margin ratio. So we'll go back into our calculation and we'll take our fixed costs plus our target operating income and divide it by 0.4, which is a CM ratio percentage. And in the numerator, we will now have $3,350,000, and we'll divide that by 0.4 to give us revenue of $8,375,000. And so that's what we need in total required sales to achieve a target operating income of $750,000, which would translate into a target net income of $450,000. And now we'll look at requirement 4, our last requirement for this problem. So after preparing some estimates, the company determined that its variable manufacturing cost for leaf blowers would increase by 20%, and the variable selling cost of hedge clippers would decrease by $1 per unit. They decided not to change the selling price of either product. It has learned its leaf blower has perceived as the best value and expect to sell 3 times as many leaf blowers as any other product. So what we want to do is determine how many of each product the company has to sell to break even. What we want to do is make sure that we identify the major things that have changed here. So the variable manufacturing cost has increased by 20%. So if we look at, for the leaf blower, we know that the variable manufacturing cost right now is $25, and that's expected to increase by 20%. Therefore, if we take 25 times 1.20, this gives us a new cost of $30, unit variable cost. At the same time, for the hedge clippers, right now we know that our unit variable selling cost is equal to $4, and the data tells us that it's going to increase by $1 per unit. Therefore, we're looking at a $5 unit variable selling cost. So if we proceed then to determine our bundle contribution margins, we need to look at each product again. We have the weeders, the hedge clippers, and the leaf blowers. And we start with our unit selling price. The unit selling price of the weeders, in fact, none of the selling prices has changed. So the weeders will sell for $28, the hedge clippers for $36, and the leaf blowers $48. Now we take our unit variable manufacturing cost, and none of that has changed for the weeders, so that's still $13. And then we would subtract the unit variable selling cost, which also stays the same at $5 per unit for weeders. So those will give us a unit contribution margin, still of $10 for the weeders. For the hedge clippers, our unit variable manufacturing cost stays the same at $12, but our unit variable selling cost will increase to $5. So now this is a $5 variable cost, and this will give us contribution margin of $19. The leaf blowers, the variable cost is now per unit $30, and the variable selling and admin cost is still the same at $6. We end up with a $12 contribution margin. So when we add those up, our total contribution margin is $41. But then don't forget, we have to multiply these by the sales mix. And right now, the sales mix for weeders is still going to be 1. The sales mix for hedge clippers is still going to be 1. But the sales for the leaf blowers is expected to increase, and it'll be 3 for every one of the other ones sold. Of course, if we multiply each of these by their respective sales mixes, this will give us a bundle contribution margin. It's $10, 19, and 12 times 3 is 36. So now we have a bundle contribution margin of $65. Then, in terms of determining our break-even point, the rest is pretty straightforward. Our break-even point Q star, and this time for bundles, is equal to total fixed cost over unit contribution margin. Our total fixed costs haven't changed, $2,600,000, and our bundle contribution margin is 65. So that's 40,000 bundles. But don't forget that bundles must be split into weeders, hedge clippers, and leaf blowers. So times 1 times 1 times 3. So that's 40,000 weeders, 40,000 hedge clippers, and 120,000 leaf blowers. And that's it. We've now completed in-class problem 3.2 on multi-product CVP.